Good evening, everyone, and welcome to Alma's monthly webinar series. We'll just wait for a minute. I'm seeing people are still logging in. We'll just wait for a minute and then start. Okay, so welcome once again, everyone, to the monthly webinar series of Almas. And my name is Maulik Shah, one of the co-founder and the CEO of Almas Risk Consulting. We at Almas are specialized in managing currency, commodity, and interest rate risk. Started way back in 2012 as a pioneer in FX outsourcing space, and from there on, we have grown to include all the three financial risks, which is currency, commodity, and interest rate. Indeed, a pleasure to have all of you in this session. Our monthly webisode series is our initiative, our attempt to share knowledge with all of you and somewhere empower and enable you in your own decision making as it relates to your financial market operations. And it's indeed our fortune to have very known speakers who have been speaking on this monthly webinar series. And one thing which I will definitely acknowledge and compliment all of you, that your interest, your enthusiasm, and as I was talking to the other speakers, today we have probably a record registration on this webinar, thanks to the celebrity speakers that we have got today. And that is really encouraging us to come back every month with the topics which are relevant to your day-to-day life. So welcome once again, all of you. And most important thing, I'm going to take few minutes more to talk about today's two stalwart speakers. I call them a celebrity speakers. And why it is important? Because there are things which are common between them, and there are things which are unique to both of them. One is, of course, the regulator, and the other, an economist. One has, throughout 35, 40 years, if I'm correct, of his career has regulated the financial economy, and the other one, on a lighter note, has regulated the regulators through his critical insights and inputs. All right. But the common thing that I'm blessed and Almas is really fortunate is that both of them have been Almas well-wishers. They have shared their insights on the Almas Rupee Money Conference platform. Another thing which is very common, and I tell this to both of them as well, is that free and frank views on any topic. I mean, there's absolutely no hesitations. It's a straight view without even thinking. I mean, rather without being hesitant about how this will be, because that's a really honest opinion that they carry, backed by research and their experience. So that's really whom we have. I will formally introduce them. It's my pleasure. First, Mr. Mahalingam, sir. He was full-time member of Security and Exchange Board of India, SEBI, looking after corporate finance department, foreign portfolio investors, and investigations departments. He had earlier worked before joining SEBI as an executive director in the Reserve Bank of India, and he has been very actively involved in regulations and development of money, bond, and foreign exchange and derivative markets in India. He is master's degree holder in statistics, operations research from the Indian Institute of Technology, Kanpur, and MBA in International Banking and Finance from Birmingham Business School, UK. Indeed, our pleasure, sir, to have you today on this webinar. Welcome, sir.
Thanks a lot, Maulik. Thanks a lot for that very profusely. I mean, it's an introduction which I am not really deserving. You made a great introduction.
Yeah. Thank you so much, sir. But you deserve more than that. But yes, pleasure to have you. And then I have Rajeswari Sengupta, one of the brilliant mind in the world of economics, as I would call it. She is an assistant professor at economics, professor of economics at IGIDR, Indian Indira Gandhi Institute of Development Research in Mumbai. In the past, she has held research positions, and something which is really prestigious. She has been holding the research positions at IMF, International Monetary Fund, World Bank in Washington, D.C., the San Francisco Federal Reserve Bank, and Reserve Bank of India. And she has been exploring several issues pertaining to the Indian economy, such as evolution of the exchange rate regime, monetary policy transmission channels, issues in the measurement of India GDP, the twin balance sheet crisis in the banking and the corporate sector, and financial constraints faced by Indian firms. She has also written chapters in edited volumes published by ADB, Asian Development Bank, and the G20, among others. So great honor to have you also, Rajeswari. Thank you so much for accepting.
Thank you so much, Maulik.
Great. So on today's topic, India bond inclusion in the JP Morgan Global Bond Index, GBI, emerging markets. I will just quote one line and then hand it over to the speakers. I don't want to take much of your time by me speaking. It's almost 10-year-old journey. I mean, 10-year long journey, as I would call it. 22nd September 2023, early hours, JP Morgan announced Indian bond inclusions. And exactly 10 years back, and I have a quote where immediately after the taper tantrum, there was this talk about the Indian bond to be included. And then RBI Governor, Mr. Raghuram Rajan, he was asked and he was quoted, we have to talk to them and see what we feel comfortable with and what they feel comfortable with. And whether there is a meeting ground, we will explore and see based on what their conditions are. So this was then on 20th September 2013, almost 10 years back. And since then, we have traveled a distance. And I invite Mr. G. Mahalingam to take us through. Both of them are going to share with us both insight and insights. So over to you, sir, Mr. Mahalingam, sir, and then we'll hear from Rajeswari Sengupta.
Thank you, Maulik. First of all, congratulations for conducting a webinar of this kind, which is absolutely on a topical subject. We have been seeing number of articles appearing in the newspaper on this and in several other media channels. So it's very nice that you have been able to organize this kind of a webinar on a very topical subject. Second, I'm going to be initially giving opening remarks on what we went through in RBI in those days. Maulik rightly quoted 2013. It's exactly the time when the dialogue started within RBI. So I would like to recount the circumstances, the events which actually triggered this kind of a discussion. Third, I'm a complete practitioner. I mean, I've been with the financial markets for quite some time. So mine is going to be born out of the experience that I observed while I was actually managing the financial markets, both rupee liquidity as well as foreign exchange markets. So some of the turmoil and volatility that we witnessed way back in 2013, I would like to recount. And I am sure Rajeswari would supplement with a brilliant theoretical concept. I think she is a real well-trained economist. I am far away from that, actually. So she will definitely come up with excellent reasoning and all that. I will be able to see I'll be able to give you the observations and she will be able to supply the reasons. Let me start off with what Maulik said. I think 2013 was a kind of a tumultuous year in India. The current account deficit was touching almost about 4.8% for the year ending March 2013. The fiscal deficit had crossed about 5%. Rupee was on a continuous depreciating course despite several bouts of interventions by RBI, right from 2011 onwards. And the foreign exchange reserves were actually stagnating at around close to $290 to $300 billion, just about supporting 7 months of imports. So this was a kind of a precarious kind of a situation. I won't really use the word precarious, but situation was actually deteriorating. Current account deficit was a real kind of a stunner at 4.8%. Now, this is the time on March 22nd, May 2013, when Bernanke announced that the US quantitative easing, what they had done, would stop and tapering would start. This was a shocker to the market. The market couldn't believe that the US Fed Reserve President is going to come and make such an announcement absolutely right from, it was like, I mean, it was more dramatic than the demonetization announcement that we heard in 2016. And the next morning when we woke up, I think the whole markets were in a complete state of turmoil. The bond yields spurted, rupee started depreciating even more, and there were copious outflows from the bond markets, particularly from the foreign portfolio investors. Now, this was, I would say, is a kind of a trigger point within RBI to discuss the subject of bond inclusion, India's inclusion in the bond index, a little more seriously. It had started a little before, but people didn't pay much of an attention. But then this particular event really provided the trigger. Combined with the government borrowing program, which was actually increasing year after year, where actually it was difficult to find investors because the government bonds had actually captive investors in the form of banks and insurance companies and a few other institutions. The retail interest was absolutely missing, and the other FPI interest actually at that time was dwindling. So RBI was left with the course to find out some additional investors. So this is the stage at which Dr. Subbarao was leaving RBI and Dr. Raghuram Rajan entered. And at that time, it was thought through that why not we actually take this a little more seriously and initiate a dialogue. So people, the index people are called, discussion started. But the first ask the index people was that you can't have any FPI limits on the bond investments at all. This came as a shocker to RBI. RBI said, we can't change the entire macro policy overnight at all. I mean, how can we completely dilute all the limits? That's going to be very, very difficult. Now, those people went back, and there was an additional, at that time, and actually the newspapers started writing articles and all, there was a bit of a criticism about this kind of a thought process within RBI. And there were articles which are actually saying that foreigners would start controlling India's macros. If India were to join the bond index, if India were to be included in the bond index, and tomorrow if India's macros went bad or deteriorated, people would actually lower the weight, and there'll be a heavy pullout out of India, and this is going to create much more problems than what we are currently facing. So this was a scenario at that time. A second round, a third round of discussions took place, but nothing fructified because we were holding on to the position that FPI limits cannot be relaxed, and the other side was saying that the FPI limit had to be completely relaxed, and we could not think of a middle path at all. I mean, it is something like you drive either on the left side of the road or the right side of the road. You can't be driving partially on the left side, partially on the right side. So people thought that there is no middle path at all. So that was a state in which actually a lot of discussions took place, but then everything ended in stalemate. Now come back to today. Today, the monetary policy in the Western nations, particularly even in the US, it has been actually going up and up. The interest rates have been going up and up. If you in fact look from March 22, 525 basis points of interest rate has gone up in US. In comparison, in India, the interest rates have gone up by just about 250 odd basis points in the exact corresponding period. Now, what has this brought about? In fact, if you look at what was yesterday's US 10-year yield, it was somewhere around 4.56. India's 10-year yield was 7.30. The differential, what we call it as a yield differential, was 274 basis points. Many of us don't realize that this is a 14-year low. I mean, we have never touched this kind of a low at all. In fact, just to recount what was 1 year back, 1 year back was close to about 511 basis points. In 2016, it was 615 basis points. With the yield differential actually narrowing further and further and further, the chances of attracting FPI flows into the government securities market or even to the corporate bond market, they were actually dimming more and more. The chances were dimming up. So basically, there are actually apprehensions in the minds of the policymakers today, but if the spread were to come down, attracting the foreign flows is going to be difficult. If people want to enter the Indian market, hedge it, they want to be still left with at least about 100, 200 basis points. If that 100, 200 basis points is not available to them, nobody is going to look at India at all. Today, exactly, we are in such a situation. So I would say, while actually a lot more dialogue has taken place after Raghuram Rajan left, after Dr. Urjit Patel left, and after Mr. Shaktikant Das took over, I think there has been a lot more happening on the FPI side. In fact, if you look at the current regime in RBI, if you look at what has happened in the FPI side, they have come up with several innovative things. The most important thing I would call is as a fully accessible route, FAR, for the FPIs. This was something which was never thought of before at all. So I would congratulate the present regime that they have been able to come up with a very innovative kind of a measure. Second, voluntary retention route, where FPIs can come and then lock up their money in India, invest in some assets, and they will agree not to take their assets back to the foreign country for the 3 years. So while there is going to be a lockup, they can actually churn the portfolio within India. So this, I would call it as another very important innovation. Now, these innovations paved the way for a further dialogue to begin with the bond index people. Now, Reserve Bank had a very strong point. Look, we are going to allow the fully accessible route. So you can come into these bonds up to the full limit. There is no limit which is going to be imposed at all. If the bonds are issued to the extent of 70,000 crores, the entire 70,000 crores could be yours. There should be no problems at all. This is where actually the equilibrium started tilting and people started leaving their rigid stance. And that's where actually the inclusion, index inclusion idea actually got fructified. So this is the stories today. I'm going to stop with this. I'll come back a little later after Rajeswari makes her presentation. Thanks a lot, Maulik.
Great. Thank you so much, sir. I think a couple of points, I'll just make a note of it and I'll come back to you. There has been a general perception among the market participants that there has been a tax and the regulatory hurdles. When I say tax, the favorable tax treatment to the foreign investors or the Euro clearing exchange, those were the real issues. Why probably this was delayed. What you are highlighting is very important point is on the capital controls. And I think that's also significant point towards, moving this needle from no to yes. So I think that's...
Thanks, Maulik. I will definitely talk about the capital controls maybe later. Yeah.
And so before I invite the next speaker, just two announcements. One, looking at the topic that we have chosen today and also the speaker that we have. I have taken the permission to extend the time if required by another 15 minutes, which is up to 6:15. That will be subject to the interest in the conversation that we have. That's one. Second, all of you may have questions or some clarifications. Feel free to put it up on the chat box. It will be for me to just pick it up and place it to the speaker. So do not hesitate. You can do that during the discussions or any time in the session. Yes, Rajeshwari, over to you on the implications, everything that you want to talk about on the important announcement that we have. Over to you, Rajeshwari.
Thank you so much, Maulik. It's an absolute pleasure to be doing again a talk for Almas, an organization that I'm deeply fond of and I've become associated with over the years. And it's an honor and a pleasure to listen to and learn from one of the best minds in the field, Mahalingam sir. The more you speak, the more I feel like I don't want to speak and I just want to keep listening to you. So hopefully we'll get more and more chance in the next hour to listen more to you. So I'm just going to share my screen because I have a short presentation that I would like to go through for the benefit of the participants. It also helps me structure some of my points. So much of what Mahalingam sir said actually helps nicely paves the way for what I am planning to do. A brief outline of what I'm going to talk about is I'm going to start from the JP Morgan perspective. So essentially, what is the bond index, and talk a little bit about the details of India's inclusion, although I'm guessing by now this is pretty straightforward. So I won't deliberate too much on this because a lot of media articles on this, as Sir also mentioned. But primarily what I want to talk about is the implications of India's inclusion in the JP Morgan bond index. What does it mean primarily from a macro perspective? And then I want to end with some salient points about the way forward. So in 2006, JP Morgan launched its EM Global Bond Index with the objective to enable investors to invest in high-yielding emerging market bonds and to enable them to hold a diversified portfolio. This is also the time from when onwards yields on emerging market government bonds started becoming extremely attractive. And this became a very widely tracked index and a very widely used benchmark for many emerging market sovereign debt funds, etc. The design, of course, of the index was to track the performance of the government bonds issued by various emerging markets, going by the weights. There's China, Indonesia, Mexico, Malaysia, and so on and so forth. So from Asia, you see, before the inclusion of India, there were China, Indonesia, Malaysia, and Thailand. These were the major countries. All of their weights, I think barring Thailand, it's about 10%. And then we also have the other BRICS members as Brazil and South Africa. So basically, other than India, most of the major emerging market economies were already a part of this JP Morgan EM Global Index. And the index, what does it consist of? It consists of highly liquid government securities, which are regularly traded. These are, of course, fixed rate securities, which are all denominated in the respective domestic currencies of all of these emerging markets, and also securities which international investors can readily access. Now, the index excludes countries where investing in the local market is subject to explicit capital control. So this is an extremely important point, that if there are explicit capital controls imposed on some securities, then those securities cannot be a part of this index. So capital control becomes an extremely important point in continuation to what Mahalingam sir was also saying. However, the eligibility consideration does not take into account regulatory or tax hurdles. So regulatory and tax hurdles can delay the inclusion of a country, but that is not a primary deciding factor about whether the country should or should not be included. Interesting thing that this index is quite dynamic. Some countries keep on getting added. Some countries, in fact, keep on getting removed. So for instance, in recent times, Egypt and China were the latest additions other than India. And interestingly enough, Argentina was removed in 2019 when Argentina was about to default on $100 billion of international debt. And the president of Argentina had imposed extensive capital controls. And remember, capital controls is a very important point on for a global bond index. So they got removed. And of course, Russia was removed last year when they invaded Ukraine. Now, where does that leave us? So last month, as Maulik was mentioning, we got the announcement that Indian government securities will be included in what is called the JP Morgan Global Bond Index for Emerging Markets. It's called GBI EM Global Index and the Index Suite. So there are many other sort of variants in the whole family of JP Morgan EM Global Index. There is GBI EM Global Diversified and so on and so forth. And the inclusion will start from June 28th of next year. What is going to be the process? Very quickly, the inclusion will occur over a period of, it will be phased out over a period of 10 months, starting from June and ending in March 2025. Every month, there's going to be an incremental increase of 1 percentage point in India's index weighting. Eventually, India will reach a threshold of 10%. Now, every country in the JP Morgan Bond Index can reach a maximum weight of 10%. So the minimum is 1% and the maximum is 10%. So India is scheduled to reach the 10% maximum weightage by March 2025. What does it mean in terms of the actual money? The index, the JP Morgan Global, the EM Global Diversified Index has an AUM of roughly $236 billion. So 10% of that is $23.6 billion. This is the amount of passive inflows that are expected to come into the Indian government securities, which will be included in this index. And I'll talk a little bit more about that as I move on. Which are the government securities which have been included? So there are 23 Indian government bonds with a combined notional value of about $330 billion, which are now considered eligible. The eligibility consideration is that any bond that is included must have at least 2.5 years left in its maturity profile. And all of these bonds are under what Mahalingam sir was also referring to, are under the fully accessible route, or the FAR, which is a specific category of government bonds that was created by the RBI for non-resident investors. And all of these bonds belong to this category of FAR. And these are the bonds which are now eligible for inclusion in the index. So these are some of the technical logistical details of the index inclusion. Now, very quickly, this is sort of carrying forward to what was said earlier. During the pandemic in March 2020, the Reserve Bank of India announced this fully accessible route category. By doing that, the RBI gave unlimited access to foreign portfolio investors to a select set of government securities, and RBI reserves the discretion to specify from time to time which government securities can be included as a part of this FAR category. And the characteristic of FAR category is that all of the G-SECs which are included in this category will not be subjected to any kind of capital controls related to ceilings, limits, caps, qualifications, none of that. So foreign portfolio investors are they are allowed to invest whatever amount is being issued. They're fully allowed to invest in that amount for G-SECs included in the FAR category. And of course, this was done to facilitate capital account liberalization. And this also aids bond market development to the extent that it creates demand for this specific set of G-SECs. Now, this means that with this fully accessible route, government securities in India fall in two categories. One are the government securities in which FPIs are allowed to invest without any limit, that is the FAR G-SECs. And the next are the government securities in which FPI investment will be capped at 6% of the total outstanding stock of the securities. So all other government securities other than the FAR ones, FPIs can only invest up to 6% of the outstanding stock, and whatever is in the FAR, they have no limitations, and by definition, therefore, they are only the ones who are eligible to be included in the global bond index. So I hope this is clear by now. So now moving on to the implications. And I want to roughly cover 4 points in the implication. One is the magnitude of the flows that is expected. What does it do to the cost of government borrowing? What does it do to what we call financial repression? And there's one more point. Now, in terms of magnitude, the total outstanding government securities in India is roughly around rupees 100 lakh crore, which amounts to about $1.2 trillion. And remember what I said, the total notional value of bonds which are eligible for the bond index inclusion are $330 billion, which means roughly 27% of the outstanding government securities are eligible. But this is the stock concept. So over a period of time, whatever 100 lakh crore G-SECs have been issued, that's the outstanding stock. Out of these, about 27% of these outstanding G-SECs are now eligible for inclusion in the government bond index. That's quite a reasonable percentage. But now let's look at the flow, which is much more relevant for the perspective of government borrowing. The annual borrowing by the Indian central government is roughly rupees 15 lakh crore. This is the projected borrowing for the current fiscal year as well, for 2023-2024, which is again around $180 billion. Now, remember the total AUM, which is being tracked by the JPM EM Global Index, is around $236 billion. India's weightage at the threshold maximum is 10%, which means we get $23.6 billion in that select set of government securities. But mind you, this is a one-off inflow into the government securities during the entire scale-in period from June 2024 to March 2025. Now, this amounts to about 13% of the annual borrowing of the central government. What happens going forward? So these are called the passive flows, which just happens by default, by definition, because of India's inclusion into the bond index. So there is a one-time very heavy flow coming into the government securities. Any active inflows are whatever is going to happen over and above this amount on an annual basis. Now, how does that work? So let's assume that the asset under management of the JP Morgan in EM Global Index increases by 20% in the next year, in the fiscal year of 24-25. This roughly takes it to $283 billion. The 10% of and therefore the increment between the $236 billion to $283 billion, India's weightage is 10%. 10% of the increment comes to roughly $4.7 billion. That is the amount that Indian government securities are going to get in that 1 year in 24-25. So there is a one-time inflow of $23.6 billion. And then over and above that, if you assume that the overall AUM of the index increases by 20%, then India gets roughly $4.7 billion in 1 year. Now, mind you, this is quite an optimistic projection because given the fact that currently with this big surge in US government bond yields, and the narrowing yield differential that Mahalingam was also referring to between, let's say, the 10-year US bond and the 10-year India government bond, given the narrowing yield differential, it's highly unlikely that foreign portfolio investors will be bullish on investing in any emerging market sovereign debt fund, which tracks the JP Morgan EM Global Index. But given that, if I still assume that the AUM goes up by 20%, we are expecting about $4.7 billion a year, which is on the incremental flow of central government's borrowing. This is roughly about 2.6% of annual government borrowing. So when we look at it from this perspective, it's actually not a substantial amount. Of course, as the government's fiscal deficit and the total borrowing comes down, this percentage will go up. But over the next 1 or 2 years, we can expect roughly 2 to 3% of the annual government borrowing is basically what is accounted for by this index inclusion, assuming that the AUM, the underlying AUM of the index, continues to increase nicely. And to put this in perspective, in the equity market, we get FPI inflows of roughly $2 to $3 billion per month, whereas what we are looking at here is roughly $4.7 billion a year, right? So in terms of the magnitude, it's relatively moderate. So it's just a one-time big inflow that happens, and then over a period of time, it sort of, let's say, stabilizes around anything from between $2 billion to $4 billion a year. Now, moving on to the point about volatility versus stability. So there's a lot of discussion that's going on. I've read in some of the articles that this inclusion might increase volatility of capital flows. Now, it's important to put things in context so that we don't sort of misunderstand what might go on to happen. If I want to take you back a few years, in the Indian equity markets, when foreign liberalization happened in the mid-1990s, there was a visible and perceptible shift from what we call alpha flows to beta flows, right? So essentially, alpha flows meaning investors directly investing into securities and stocks versus beta flows, which is investors investing in things like ETF. So you invest in a Nifty 50 fund, etc. So that's more like the beta flows. So increasingly, there has been a shift, and particularly with the rise of mutual funds, there has been a perceptible shift in the investor appetite from these direct alpha flows into specific securities. Instead of that, towards more exchange-traded fund kind of indirect beta flows. And globally also, we see that there has been a gradual and steady move towards index funds, both for the equity market as well as for the debt market. And there are, of course, therefore, as a result of this, there are benefits for India to be included in more and more indices in keeping with the global trend. And this is important because think of it from the FPI perspective, right? It's almost the perfect analogy is you are doing stock picking versus you are investing in Nifty. So likewise, for FPI investing in the debt market, evaluating individual government securities issued by the Indian central government is much more expensive compared to just trusting the JP Morgan index and investing in that index. And more likely they are going to be doing the latter. It's exactly the same reason why we would invest in Nifty as opposed to individually picking up some stocks. And also some stocks may simply just go out of fashion, whereas when you're invested in Nifty, the Nifty 50, the 50 stocks are constantly getting whatever investment is coming through. So, for example, in June 2023, FPIs in India used up less than 20% of their total investment limits in government securities, which was the lowest since 2014. And of course, this happened because of the surge in the US government bond yields, and FPIs were very aggressively pulling out of the Indian government securities market. Now, this means that if they have to do this evaluation of individual securities, they are more prone to pulling out of the market because it's also very expensive for them to keep tracking individual securities and their returns. So what happens is when you are part of an index, there is an assured source of inflows that you're always going to get. So to the extent that the AUM of the index remains stable or even continues to go up, to the extent your weight is 10%, you're always assured a certain amount of inflows into that specific set of government securities. And of course, it can also go the other way around, in the sense that if the AUM goes down, then of course, given the weightage, the inflows can also go down. But currently, given this surge in bond yields, when a lot of FPIs are pulling out of individual securities, being a part of an index sort of provides a kind of shield or protection against significantly more volatile outflows that might happen if FPIs are just invested in individual securities. So for example, in August 2023, FPI significantly reduced their holdings of individual FAR bonds. So the same FAR bonds which are a part of the index, we saw that FPIs were pulling out of some of the 10-year bonds and 30-year bonds, which were part of the FAR category. But now when these FAR bonds are a part of the index, and to the extent that if all FPIs are invested in the index, these bonds will continue to keep getting inflows. So in some sense, bond inclusion becomes a source of stable capital inflows for the recipient emerging market, in this case, India. And yes, of course, in any emerging market, you'll always be subjected to the vagaries of the global shocks. That just goes without saying. But being part of a global index versus just FPIs investing in individual securities, if these are the two options available, then being part of a global bond index definitely makes the flows much more stable for the reasons I just described. The third point, and I'll move a bit quickly here, is that, of course, there is going to be an increased demand for Indian government securities, right? Simply by virtue of being a part of the index, anytime the AUM of the bond index increases, inflows into Indian government securities goes up, and this increased demand pushes down the yields and lowers the cost of government borrowing. Why is this relevant? Given that Indian government's debt to GDP ratio has been close to 90% over the last 2-3 years, interest expenses on government debt account for as high as 40% of government revenues. That's extremely big. I mean, that's a very important component of government's revenues that is just going away to pay interest expenses on its debt. So therefore, if the bond yields come down because of the FPIs investing in this index, then to that extent, the cost of borrowing comes down. But mind you, all of these has to be caveated by the point I mentioned earlier, which is that the actual amount of inflows coming in every year is not more than 3% of the total borrowing. But still, it's still something is better than nothing at all, where FPIs are just pulling out of individual government securities, which makes situations much, much worse. The fourth point, and this is extremely important from the domestic economy perspective, is that in any emerging market, any economy for that matter, there's a finite pool of savings available for investment. And the more the economy has to grow, we need more and more savings available for investment. And that becomes a problem for emerging markets like India, because the available pool of savings is constantly split between the government and the private sector. And to the extent our fiscal deficit is very high, it's currently 6% of GDP, central and state together is close to 10% of GDP. And to the extent that most of the government debt is held domestically by a captive audience of institutional investors like banks, insurance, pension funds, etc., there is a very high degree of financial repression, because whatever savings is being appropriated by the government is exactly the amount of money that is not available to the private sector. And this is in macro, this is what we call crowding out. Roughly, this is just a back of the envelope calculation that I did with my co-author Harshvardhan, is that if we look at the historical long-run average growth rate of the capital pool available in some of these domestic institutions and the regulatory minimum amount of government securities that they are required to hold, roughly the amount of capital pool that is available for the government to dip into is 15 to 16 lakh crore, 15 to 16 trillion. Over the last 2-3 years, the government borrowing was actually to the order of 21 trillion. So which means whatever additional borrowing the government was doing is what we call unexpected financial repression. So this is the money that should have been available for the private sector to borrow, but instead, because of the government's high level of borrowing, this was being crowded out. And in any case, even within that 15-16 trillion that I mentioned, which is the capital pool available for the government to dip into, that itself has a component of financial repression, because there are regulators who are mandating banks, insurance, pension funds to hold certain percentage into government securities every year. So that itself has a component of financial repression. So the extent of financial repression in emerging markets like India is actually pretty big. And this is a constant constraint for access of the private sector to credit and hence investment. The situation gets significantly worse if savings are falling, which is exactly what we're experiencing now. Recently, RBI released a report that household net financial savings have come down to 5.1% of GDP, which is the lowest level in the last 3 or 4 decades. And it also gets worse if demand for private commercial credit picks up. In that situation, increased access to global capital through this inclusion in a global bond index definitely eases the pressure of financial repression. And the more we get included in such indices, the more the incremental capital inflows, which are relatively more stable, and then hopefully the financial repression that the economy is being subject to starts reducing. So that is definitely a good thing. And I'm almost towards the end, Maulik. Now, way forward, very quickly, this inclusion of bond index is almost akin to India getting listed globally, right? So therefore, to that extent, it invites greater scrutiny towards India's macro-financial stability. Particularly important is government's fiscal consolidation path. Now, as you all know, in the budget, it was announced that the target fiscal deficit is 4.5%, but there is no well-defined medium-term fiscal consolidation strategy that has been laid out. And this is something that needs to be watched out for, because while India becomes a part of the global bond index, it is also possible that if the fiscal consolidation does not happen, then the weight may actually come down from 10%. Because remember, it's between 1 and 10%. And if the weight comes down to that extent, capital inflows also go down. Second thing, very quickly, is India has a very complex system of capital controls. And with my co-authors, I've done a lot of research on this. Roughly speaking, over the last, from 2000 onwards, every year there were about 5 or actually 9 times the rules for capital markets were changed, and more than 40% of these capital controls apply to debt securities, including government securities. And it's a very highly fragmented regime. There's some FAR, there's VRR that Sir mentioned, there's medium-term framework, etc. Now, this inclusion in the global bond index can actually pave the way for the RBI to further simplify the capital controls regime and allow more and more government securities into the FAR category. Currently, these are just a few maturities which are eligible in the FAR category, but if RBI allows more government securities, it also creates more liquidity in these government securities and also enables market development. And this also works towards the larger goal of capital account liberalization. And it's worth remembering that in this particular case, it is the foreign investors who are bearing the currency risk, because they are the ones who are investing in rupee-denominated government securities. We don't bear any currency risk. So that is something that we should be mindful about, that to that extent, they are the ones who are in sort of a quote-unquote volatile zone compared to the recipient country. Lastly, what to watch out for, and I'm happy to talk about this in the Q&A if we have time. Will this mean that the RBI intervenes more in the foreign exchange market? Will this mean that the RBI will continue to manage the bond yields as it has been doing, particularly in the pandemic period? And will India get included in other global indices like the Bloomberg Index and so on and so forth? So these are some of the things to watch out for. So my last slide, the overall magnitude of annual capital flows that we are likely to get is going to be moderate over the next 1 or 2 years at least. But this is an excellent step in the right direction. It has a very big signaling effect, and it also brings in stable flows. And hopefully it will pave the way for more positive developments to sort of announce India's arrival on the global stage. So with that, I'm going to stop. Sorry, I may have taken a little bit more time than was scheduled for me.
It was worth the time that you took, but there was an excellent coverage that you had, Rajeswari. I'm just going to have a follow-up, 1 or 2 points. You said there are other global indices which can include India. How much of the quantum that can be?
Very good question. So I think the JP Morgan Bond Index AUM is the largest, and we already are in it, right? So basically $24 billion is exactly what we are now looking at. The Barclays Bloomberg Index, that's the other one. I don't exactly know from the top of my mind what the AUM is, but it's less than the JPM one. So I think even if we get included and given that the incremental flow from even the JPM inclusion is going to be around, let's say, $3-4 billion, I would say roughly we're looking at about $5-6 billion a year in terms of government borrowing, assuming that the AUM also increases in quite a big way. There's another one, the FTSE, but I think there's a bit of a hurdle because they need the credit rating for the Indian government bonds to go up. So we don't satisfy their credit rating requirement. So essentially, there's only just one right now, which is the Bloomberg Index. And their evaluation, I think, happens in November. So we have to wait and watch to see whether this news impacts their decision or not.
Sure. So all in all, we are talking about $25 billion for the next year, or 23.6 to be precise, and then incremental hardly $2 to $3 billion a year. If at all included in other bond indices, then it could be additional maybe $5 or $10 billion, which again is a one time, and then the incremental in the year follow.
Correct. So, that's right.
All right. So
it's not a very big percentage of the annual government borrowing.
Sure. So, but the move is significant. It indicates something, and it has come on the backdrop of a lot of work that like you said, RBI would have done it just to, be included. And on that, let me now come to Mahalingam, sir. And few points that the presentation highlighted in terms of the RBI, the impact on the currency market, impact on, there are obviously, it has come at the time when the yields have narrowed down. So while there'll be a passive flows which will still be there, but it also brings a lot of onus on the government, whether it is a fiscal prudence or, things that they need to do it. In terms of the Reserve Bank of India and the government, what all things they are expected to do in terms of this particular announcement which has really come up? So for you.
Yeah, that's again a very good question. But I think I'm just making a guesswork because I'm well out of RBI. I'm no longer within RBI at all. Now, first of all, I think Rajeswari mentioned about 25 odd billion flows. Just one moment, I'll close the door. My grandson is creating a ruckus here.
No worries, sir.
Yeah, right. Roughly about $25 billion that she was mentioning. To that, I would like to add maybe a few $1 billion more, because as the index is going to be becoming operational and getting benchmarked in June of 24 up till March of 25, there will be a lot of individual investors and fund investors who will try to front run this actually, in the hope that as this money comes in, the yields will go down. So to that extent, there will be front running flows also, which will be coming into the country. I'm not sure how much of the magnitude of that will be, but a general thumb rule, we can say that it could be about 10 to 20%. So it could bring in an additional 2 to 4 billion flows into the country. So overall, I'll put it somewhere around maximum about $30 billion. Here, when we come to what RBI is going to do, first, number one, will the bond yields dip in India significantly? Number two, will the rupee appreciate significantly? These are two questions which completely depends upon what RBI is going to do. In my own opinion, I mean, having operated in that desk and having observed the RBI governors for almost about last 15 years, during periods of turmoil and during periods of appreciation, rupee appreciation, as well as bond yields dipping, I would venture to guess that RBI may not be very comfortable with rupee appreciation at this stage. Now, there are several reasons for that. If you look at the real effective exchange rate index today, whether it is you are taking the 2016 base or whether you are taking the last year as a base, and whether you are looking at the 6 currency index or whether you are looking at the 40 currency index, actually the rupees RER is staying well within a band of 2 plus or minus 2%. Now, this is in fact much more than what Tarapur had advocated way back in 2000-2001 when he talked about a plus or minus 5% band. So since it is very well within that, if you are going to allow the rupee to appreciate heavily from here, rupee will actually become very heavily overvalued. And to some extent, it will actually again tarnish the performance of the exports, which are already putting up a pretty lackluster performance. So this is something which Reserve Bank is going to have in mind. I don't think Reserve Bank is going to allow a very steep appreciation of the rupee. So to that extent, what they would do is, as the flows come in, they would step in and they would try to buy up the dollars. Now, number one, it achieves two objectives. It achieves the objective of actually boosting the foreign exchange reserves of the country. The foreign exchange reserves, after touching about $642 billion high in September 22, it has been again stagnating at those levels, or they have come down all the way to about 570. Now they are closing in towards about 600. But we have not seen that going back towards 642. I am very sure that Reserve Bank would like to build up this arsenal, because as the economy grows, and we are all projecting close to about 6 to 7% growth for the economy, certainly Reserve Bank's ammunition as far as foreign exchange reserves also would have to go up commensurately. So they will use this as an opportunity to buy up the dollars. Second, now when they are going to buy up the dollars, they are going to inject rupee liquidity into the system. Now this rupee liquidity cannot be allowed to remain in the system. Today, the stance is one of tighter stance, and it is actually they are trying to withdraw liquidity from the system. They are trying to manage inflation by withdrawing liquidity. So obviously, the tolerance for increased liquidity into the system is going to be pretty minimal. So Reserve Bank will be coming up with a kind of open market sales operation of the bonds, where they will sell the bonds and try to actually suck back the liquidity. This is where I feel an exact neutralizing influence of the foreign investors getting into the Indian bonds and Reserve Bank actually selling the bonds into the system would neutralize each other. And I really don't think the bond yields are going to dip very heavily. I talked about a second objective, and second objective is again in line with RBI's monetary policy. RBI does not want the interest rates to go down in a hurry at all. So whether it is through a 10-year yield or a 2-year yield or a 5-year yield, they won't like to signal that they have a comfort by the yields dipping in a very significant way. So I certainly feel RBI would step in and RBI would ensure that this is going to be, the yields are going to be fairly steady and the rupee is not going to appreciate substantially. So this is the first thing that they are going to do. The other side, the current account deficit in the last about couple of years, the expectation was that it would touch about $100 billion. It was hovering around $90 billion. It's reasonably okay for the country's economy right now. I mean, a 2 to 2.5% current account deficit is not going to cause too much of a harm from the exchange rate perspective or the funds outflow perspective. So from that perspective, tomorrow, if the GDP of the country goes up, commensurate, the imports would go up. And if the exports remain lackluster because of the fact that the Western nations are going to take a little more time to come back into their activity, certainly the current account deficit would grow. And they would like a funding proposition for this current account deficit. I talked about a dwindling interest rate differential. In the scenario of dwindling interest rate differential, you will find much less of money is going to come from the active funds. So here is where the passive funds are going to play a very important role. And if this is going to bring in about $25–30 billion into the country, it could be one time, I agree. But then every year, as Rajeswari rightly put it, as the passive fund benchmarking goes up, it will bring in an additional $1 to $2 billion. Although insignificant, it is still significant from the angle of covering the current account deficit. So RBI is going to be comfortable from that angle that the foreign exchange reserves would get boosted and they will get that much ammunition tomorrow if there were to be an oil price zoom. And in which case, if RBI is forced to intervene, the foreign exchange reserves will provide sufficient ammunition for RBI to intervene and still keep the external sector in a very healthy position. The last point is I would like to reiterate what Rajeswari said. Rajeswari made very good points about the government impact. The government is going to be concerned about the fact that once a bond inclusion takes place, there is a kind of a macro-prudential supervisor sitting on top of them, and they are watching everything. Every single fiscal slippage will be watched very keenly from now onwards. And this, the government of India has to be very, very careful about. I'm not saying that overnight they are going to reduce the weight of India or they are going to throw India out. India's macros are definitely not that bad at all. But certainly, we are not only going to be scared of the rating agencies from now onwards, we are going to be bothered about the flows. So this is something which the government is going to keep in mind. So this is going to be something where the government has to conduct this entire macro prudential and macro operations in the economy absolutely carefully. This is what I would like to say right now.
So, Mahalingam sir, on the point of the current account deficit and that getting funded through this source. So just one again point to understand, when Rajeswari talked about it, when we have a $25–30 billion, which is significant, incremental we are talking about maybe $2 to $3 billion, which per se may not be really that. I mean, we are looking at $80–90 billion of current account deficit.
Yeah.
So are we looking at additional sources of, I mean, through this route, which is way beyond currently what we are predicting it to come in? I mean, is it really significant enough for us to, have the financing through the foreign investors? I'm just looking at
I would say as things, I mean, let's assume our macro things are managed very well. I'm sure that India's weightage would go up. I can't understand that Malaysia's weight is 10 and India's weight is 10 today. In fact, India's weightage should be much more than Malaysia. So I would say over a period of time, we should be targeting a weightage of close to about somewhere between 15 to 20%. And as Rajeswari rightly put it, as the passive funds grow in size and India's weight goes up, I think this is going to add a significant heft of inflows into the country. And then the inflows through any route it comes, it's going to definitely fund the current account deficit. Now, while it could be looking small, except for a one-time flow now, the rest of the flows could be very small. I am feeling that if the macros are managed well, India has a potential to attract significantly stable and higher magnitude flows.
Sure. So, and I want to come to Rajeswari. Yes, in fact, I want your views as well. One is, of course, on the quantum. The other is also on the credit profile. I mean, what kind of a pressure will this put on the fiscal prudence, given that already you have a critical views about it? So, over to you.
So I think one thing I want to clarify is that the JP Morgan EM Global Index is designed such that the maximum weightage of any country is 10%. It can't exceed 10.
Oh, right. Okay. Sorry, I missed this point.
Yeah. So because the maximum is 10 and we are already going to be reaching 10 by March 2025. So once we reach 10, we have reached the maximum threshold. Then whatever incremental flow comes into the AUM of the index, we get 10% of that incremental flow every year. So that's basically how it's going to proceed. Now, so yeah, I mean, it can go anything from 1 billion to 4 billion, because I don't think in a world where there is a global recession coming in, savings are not going to increase. Savings are very sticky. So they are not going to increase in a very exponential way. And in general, if the yield differential with the US is going to keep narrowing, then the appetite for emerging market bond fund will also not be very strong. So I'm guessing for the next 2 to 3 years, the incremental flow is not going to cross 4 billion, roughly speaking, right? So that, yeah, so all said and done, it is not a very big percentage of either the government borrowing or the current account deficit. So I think that the signaling effect is extremely strong in this. And Maulik, to your second point.
Sorry to intervene here, Rajeswari, you also mentioned about the other indices.
Yeah, the Bloomberg
if India
index
gets included in the other index because of this,
yes,
perhaps if there is a chance of getting some additional flows out of that.
Yeah, so maybe 1 2 billion
those
there.
Index, indices may not be as heavy as JP Morgan.
Correct.
Yeah.
So I think Bloomberg index is the only one sort of, that's the major one. And if we do get included by November, we'll come to know. Then, I mean, maybe let's say $1 to $2 billion more. So that's pretty much what we're looking at every year. So, and also we have to keep in mind that the government borrowing is scheduled to come down, right? The government borrowing was at its peak in the COVID of 2021 lakh crore. Already we are down at 15 lakh crore. And hopefully over the next few years, if the fiscal deficit also comes down from 6%, is also scheduled to come down. And then as a percentage of government borrowing, this amount of capital inflow is going to look bigger. So that also something that we have to keep in mind. And then in the medium term, once the yield differential starts widening and all of that, we can speculate maybe even more inflows will start coming in. But the one thing that's important to keep in mind, Maulik, and through your second point, I was actually very curious about the timing of India's inclusion in this bond index. The reason is because while our macro is looking definitely stronger than many other emerging countries, we also have a very high level of fiscal deficit and a very high level of debt to GDP ratio for an emerging market. And any inclusion in a global bond index significantly increases the foreign investor scrutiny on India's macro. And if you look at macro, there is inflation, there is growth, there is CAD, there is fiscal. On fiscal, I think we are the weakest out of all of these four. And as I said, so far, in the next 2-3 years, by 25-26, the target fiscal deficit is 4.5% or less. We are currently at 5.9%. There doesn't seem to be a very well-defined path to go from 5.9% to 4.5%, right? I mean, the possibility of the government increasing taxes can practically be ruled out this election year and post-election. What expenditures are going to be rationalized, it's really not very clear. Subsidies and welfare schemes are already running the way they are running, and we haven't really seen any rationalization there. In fact, if anything, public distribution system has been made free, so there is that amount of cost. So what is the path forward to bring the deficit down from 5.9 to 4.5 is not essentially very clear. And to that extent, this coming budget will become very important. And that is something, so exactly as Shah said, it's not like the weightage of India right after inclusion will get reduced. That's not going to happen. But there is a periodic assessment of every country's weight that happens in the global bond index. And if, let's say, there is the worst case scenario that we are not able to reach the fiscal deficit limit of 4.5%, which already is very high than the FRBM limit of 3%. and if the debt to GDP ratio does not come down, the GDP growth is not 7%, if all of these things don't work out, then the situation becomes a little bit tricky for us. So it's interesting. The reason I said the timing is interesting is that we are actually subjecting ourselves to greater global scrutiny at a time when the fiscal situation may not be the strongest compared to, let's say, there was an era when fiscal deficit was less than 5%. Now, if there is a plan to bring the deficit and the debt levels down, then well and good, then we are totally on path. But if not, then that's why I said that is something that needs to be watched out for, because that is the weakest of all the four macro indicators. Current account deficit, of course, we are essentially vulnerable to the global players. And to the extent the global slowdown happens, exports will keep decreasing. I just want to add one quick point to what Sir said about the currency. I think there are two tensions on the exchange rate, which are almost, one is stronger than the other. To the extent that the US interest rates will remain high in the foreseeable future. The US government debt to GDP ratio is close to 136% of GDP. That's very high. So till they try to bring it down, and their fiscal deficit is also 6%. So till their fisc comes in order, the US interest rates will continue to be high because there's a constant selling of government bonds that's happening, and that's pushing up the yields. And the Fed is not showing any sign of lowering the rate. If anything, they're going to hold it higher for longer. So if the US interest rates remain high and the yields remain high for the foreseeable future, the yield differential with India will continue to stay narrow. And if that continues, then there's a constant pressure on the rupee to actually depreciate. And barring that one-time inflow of $25-30 billion, if the annual incremental flow is just about $3-4 billion, then that doesn't really put a whole lot of pressure on the rupee to appreciate compared to the depreciation pressure that is happening because FPIs are pulling out of the equity market. So there are these two conflicting forces operating on the rupee. Currently, for example, the RBI is selling a lot of dollars to defend the rupee and prevent it from depreciation. Now, to go from there to try to prevent the rupee from appreciating, I think the flows have to be significantly higher. So that pressure is something that I think we are going to witness for the foreseeable future. Although research shows that historically RBI does an asymmetric intervention. They intervene much more when the rupee faces appreciation pressure than when the rupee is about to depreciate, because it's always relatively easier to shore up reserves than to lose reserves. So if the appreciation pressure picks up at some point, then exactly the mechanism that Sir says will kick in. And there, the problem is you're nullifying the exact effect that the bond market discipline is supposed to put on the government securities, right? The bond market is supposed to act as a disciplining mechanism for the government. If you nullify the yield effect by you being another big player in the bond market, you're sort of nullifying that mechanism. And if you continue, and this is my pet peeve, if you continue to be a big player in the currency market, you're also distorting the development of the currency market on an ongoing basis. So these are the two things that I think we should watch out for, but I'm going to stop here. Thank you.
Perfect. You are entering into the favorite topic that you always would love talking for the next probably several minutes, hours. I'll just pick one or two points that you mentioned and very critical. In fact, in a way, what you just said, Rajeswari, in terms of the pressure on the rupee from a depreciating side, in a way, it will probably serve the purpose and the objective that Mahalingam sir talked about, that, we really want a competitive currency. So in a way that works well, but yes, too much of an volatility is what also RBI is trying to manage. So they also don't want too much of a pressure on either side. I have related points which is being highlighted by Viraj Kulkarni. I'm just going to read that. Yes, I got that excellent initiative and information. Kudos. Thanks to all the speakers, both the speakers. From my experience, and that's a point which he's making, local and global, FPIs investing in debt versus those in equity derivatives are mostly in different segments. This initiative makes the debt segment more attractive and attract new types of FPIs, those that invest in debt. As India targets 6 trillion of GDP, this segment will also grow significantly. In fact, this segment leads to wealth creation as well. Is that a fair assumption?
Yeah, I would say that the one thing is clearly we need to look at expanding the gates through which actually the government finances could be financed. The government finances, the gap could be actually filled up. Clearly, when we are looking at a 5 trillion economy, the government's corresponding borrowing program, even if it is able to bring down the fiscal deficit to say about 3 to 3.5%, will continue to remain pretty high. So we need to find out other sources. So one that RBI has been actively looking at is the retail investors, but it has still not gained that much of attraction at all. Now, the other things that we are looking at is maybe the other captive investors in the country, but then the captive investors, again, it tantamounts to a financial repression, as Rajeswari rightly put it. So obviously you can't increase the SLR and all those kinds of the insurance companies investing more in the government securities. This is where I feel that the universe expands to the foreign investors, and perhaps we may have to look at the foreign investors with a clear focus that whether they can bring in more of funds to the country. While the foreign investors come into the country, they come with a Damocles sword that they can take back the entire money in a jiffy. But then we have to live with the Damocles sword, because if we have to be a growing economy and we are looking at the foreign fund support, we have to manage our macros very well. So I would say clearly, if India has to grow to a 5 trillion economy, we need to really open up these gates, and we need to actually look at convertibility with maybe a kind of a focus. We have been actually pretty conservative on the capital account convertibility front. Perhaps we had to really, I think, dilute that kind of a reluctance, and we need to look at it to open the gates a little more. Now, clearly, what is going to happen? If we are going to open the gates more, clearly, you cannot actually allow only one-sided flow, saying that the flow cannot go out at all. Then the flows are not going to be attracted. So if the entry gates are going to be open, the exit gates are also going to be open. So what is India going to be uncomfortable about is exit gates getting open. But the exit gates to be open, but still people unwilling to take the money out, it's going to completely depend upon the macro management of the country.
Excellent. And I think on that point, sir, if you can also share your insights, because Rajeswari did talk about it was not a tax or regulatory hurdle that that delayed the process. It was more of a capital controls. And that capital controls have actually liberalized over last 10 years. So if you can really share what exactly has led to those kind of a liberalization on the capital front, and how come, this shift, which probably has allowed the inclusion of the bond indices.
Yeah, clearly, I think we have been, right from Tarapo's time, we have been saying that capital account convertibility is not a one-time, it's a kind of a high-bang affair. It is something which is a process. And that process, Reserve Bank as well as the government of India, they've been actually standing to their word. They have been doing it in a very gradualistic way, and as much as the economy can tolerate. Now, today, when we are talking about an LRS of about $250,000, we are thinking that, okay, $250,000 in the initial years did not tantamount to much, but today it is tantamounting to a very significant amount. But then we are of it, and we are liberalizing it in a way that people are not going to be inconvenienced, but at the same time, they have the liberty to take the money out. So all that I would like to say is gradualism has been the real thread of this policy. And we are not going to open up the capital account in just 1 or 2 years. This process will continue, and this process may continue for the next about 10-15 years, where actually each and every channel slowly it will get widened, and that's going to really aid the Indian economy.
Got it, sir. There is one question, Rajeswari, I'll put it up to you. Any impact to the India debt to GDP ratio, which is currently at 84%, would it be sustainable?
So, Maulik, before I take the question, just a couple of comments on the previous point. So, I think on the capital account liberalization, what happened in India was that we liberalized FPIs or FIIs access to equity market much easily and much quicker. And we were relatively much more conservative about allowing FPIs access to the debt market, because there is the entire fear about hot money, volatile flows impacting the debt market. But over the last 6-7 years, what we have seen is that there has been a significant and progressive liberalization of capital controls on the debt market. And that is basically what paved way to this bond inclusion. So to answer the question earlier, it's a nice shift that with FPIs, FIIs allowed entry into the equity market, now they're allowed more and more entry into the debt market, and hopefully the trend will continue, because now even the debt market framework for FPI investment is extremely fragmented, because there's VRR, there's medium-term framework, there's FAR, and there's a lot of scope to simplify the rules and bring more and more government securities into the FAR framework. And exactly as sir mentioned, we need more foreign capital. We don't realize how important this is, because we always think of volatility as a problem, but we have to learn to manage volatility, because we desperately need foreign capital. If we really want to reach $5-6 trillion of GDP, I don't really buy verify those numbers, but let's see, if you have to grow at 7-8% for the next few years, we need savings for converting into investment, and our domestic savings are falling. And a lot of that savings is already been appropriated by the government. It's not coming to the private sector. So simply by looking at this framework, we need access to foreign capital so that the government can start funding using foreign capital, free up much of the domestic capital for the private sector. So to that extent, the more the better. Now, on the point about, what was the point? I've forgotten.
So the question is on impact to the India GDP to GDP, debt to GDP ratio, which is high.
Yeah. So see, the debt to GDP ratio skyrocketed during the COVID period, expectedly, because the fiscal deficit became extremely high, right? And as GDP shrank, essentially, just by mathematically, it became extremely high. It became close to 90% of GDP, which was the highest India's debt to GDP ratio in recorded history. Now, as I said, as the fiscal deficit comes down, and we are on a downward trajectory, the debt increases only to finance the deficit. So as the deficit starts coming down, automatically the debt to GDP will come down. Also because the GDP is on an upward trajectory as well. So as nominal GDP grows, the overall deficit comes down, then the debt to GDP ratio will automatically come down. This has nothing to do with the bond inclusion per se. The bond inclusion is about what is the composition of the debt. Is it domestic debt versus foreign debt? But to the extent that there is whatever debt, whatever borrowing the government is doing, that itself is going to come down as the deficit starts coming down. So it is on a downward trajectory already. And we can say that if the fiscal deficit comes down to 4.5% or less by 25-26, by then the debt to GDP ratio will significantly come down below 80% of GDP. And that's important because, as I said, interest expenses are a very big percentage of government revenues. So if the government has to keep on paying high interest rate, that doesn't help. And therefore, that foreign capital inflow will definitely help there.
Sure. The last question, I want to put it up to both of you. And I just saw that in your slide, the risk of removal from the indices. Of course, we have only two cases, Argentina and Russia. Russia, we all know. Argentina is all about capital controls, bringing in. So what is the risk and what are the mitigation plans?
Sir.
Yeah, if you were to ask me, thankfully, we are not Argentina, we are not Russia. We are not going to invade any country, and we are not going to completely clamp down capital controls like what Malaysia did at some point of time. But what we should be still bothered about is what exactly Rajeswari mentioned. I think the fiscal side. Now, there has to be a greater attention on the fiscal side. Now, when we have set a target of about 3%, I think the world gave us a reprieve when COVID struck and the fiscal deficit went up. People knew that, okay, the whole world was under a kind of a pressure. But now that everything is gone, I think there has to be a purpose, there has to be a focus, there has to be a clearly set roadmap to achieve a fiscal deficit of 3%. Now, that roadmap we cannot afford to dilute at all. Now, this is something where I feel the country is going to be very, very closely watched. Again, Rajeswari very clearly said when you took the other macro parameters of inflation or the current account deficit or the foreign exchange reserves, I won't say we are in a very comfortable position, but we are definitely not in a difficult position. So given that it's a fiscal deficit which has to be managed, and unless we manage the fiscal deficit well, it's going to be a real Damocles sword on our head.
Got it, sir. Yes, Rajeswari.
See, I think in the initial years, this is definitely, it's more positive than negative because, we are going to get inflows, we even get included in the Bloomberg index. There'll be a lot of euphoria. Generally, the bond market, development, liquidity, all of that is going to get a big boost, which has been long awaited. But other than the fiscal point, and sir exactly said that, and I've already said it, that's something that the government has to put in order. I mean, we just have to achieve fiscal consolidation, fiscal prudence. There is no way outside that. We will be very closely watched. There's credit rating at stake. There is change in the weights that is at stake. And there is a global image. I mean, this is India getting listed globally. It's that big. And we don't want to be in a situation that 2-3 years after getting listed, our weight comes down, right? It just doesn't look good globally, as simple as that. So I think the fiscal part is extremely important. We have to reduce deficit, have to reduce debt to GDP. The other thing which is also very important is, again, the bond market typically should act as a disciplining mechanism on the government's fisc. One of the reasons that the Indian government has been able to borrow as much as it wanted is because it always had access to this captive domestic audience, which could be financially repressed, and the RBI could manage the yields, the cost of borrowing was low, and the government could take the debt to 90% of GDP. A foreign investment coming in, foreign capital coming in, puts that kind of an external disciplining mechanism that should be allowed to work, right? And therefore, the RBI intervening in the bond market, RBI intervening in the currency market. See, because for the foreign portfolio investor, they would want stable exchange rate. But if the RBI starts intervening even more in both the currency and the bond market, then you're distorting the markets and you're also taking away the disciplining mechanism of the bond market on the government fisc. So I think that is something that is very important to remember, that markets should be left to themselves and the regulator should play the role of controlling market failure. And I'm going to end with that.
And
No,
Maulik,
just about 10 seconds additional. I just want to mention that while divestment is considered as only a kind of a one-off kind of a supporting thing as far as risk is concerned, I would definitely add a lot of value to divestment. I think the government should pay a lot of attention. They should set good targets. They should be able to attain the targets. Now, if this is consistently done, we have so many assets to be divested over a period of time. While it will not actually repair the fisc, the ongoing fisc, but this will give a lot of comfort as far as the overall fisc is concerned.
And one point, Maulik, is, see, on capital controls, right? We are always wary of investors taking money out of the country. So one thing that the RBI and the government need to avoid is imposing capital controls on the outflows. If you're not allowed to take the money out of a country, you are not going to bring money into the country either. And JP Morgan index, by definition, they will exclude bonds if there are capital controls. So there's a disciplining mechanism for RBI as well. So it'll be very interesting to see how this pans out for the policymakers.
So in a way, they have acknowledged the fact that RBI is actually way up beyond that, isn't it?
Yes, I mean, they are actually subjecting themselves to the international market discipline,
exactly.
which is interesting. And by the way, to the extent that there's a lot of talk about rupee internationalization, right? I mean, we want the rupee to, at some point of time, maybe during our lifetimes, to become an international currency. These are the baby steps. I mean, you want the capital account liberalization, you want global bond index inclusion, you want to be that good liberal democratic country where all of these things can get done. So it's a step in an absolute right direction. And now we just have to do our small bits.
I know it is 6:15, but I think this last question has come from one of our another strong well-wisher, Rao sir, Yashwant Rao sir, whom maybe you all know. If the BJP does not get the majority in 2024, would the inflow be affected badly? Just a guess on how bad it can get.
No, clearly, I think it's a political question. And any country which does not show political stability, I don't think it is going to be very easy for them to attract foreign flows. Now, whether I'm a supporter of BJP or whether I'm not a supporter of BJP, at least country was seen as politically stable. Now, if this goes away and we enter back into a era where there is a constant fighting and bitterness amongst the political parties, naturally the policy making will get affected. And when you are going to liberalize, again, liberalization is going to get affected. It's a different matter. Narasimha Rao did it at that point of time, even with a kind of a minority government. But it is going to be very difficult to make a cogent policy making towards liberalization with a kind of a fragmented or a coalition government. So I would say from that perspective, initially it would send some shock waves. So to that extent, it will get affected. Later, people will sit up and watch how the coalition government is functioning. So all these are going to be something where only time can give us the answer. Because all said and done, India is still a very attractive investment destination. So unless politicians try hard, the economy cannot be spoiled to that extent.
Yep.
I would actually say that it would not matter. Because see, that's the benefit of the index. Once you're part of an index and once you are going to, as long as JP Morgan EM Global Index keeps on getting investment from the emerging market sovereign debt fund, MIT fund, Canadian pension fund, etc., we are going to continue to get that 10% weightage of inflows. And at that point, investors are taking a call on the index. They are not just taking a call on Indian government securities. So that is actually what shields us against these one-time shocks. Exactly. So had it only been FPI selecting individual securities, then the volatility would have been much more. But the index actually gives us the protection against political instability and all of these news, provided we don't end up doing something extreme like waging a war or imposing capital controls.
I think that's a very relevant point. This actually insulates the volatility against the volatility. So extremely enriching conversation, really thanking both of you. I'm just going to quickly sum up. We have seen 10 years of the hard work. We are in the bond indices, great news, a lot of euphoric, but I think there are key points that speakers have really highlighted, very well noted. One is the impact on the rupee, the competitiveness, that could be a depreciating pressure and an appreciating pressure, and the government intervention in the bond market and the rupee market, the fiscal prudence, the great news. It's a bold decision, but also it comes with a lot of responsibility on managing the fiscal to be sure that we are well relevant and making sure that the foreign investors the interest is being protected. And at the same time, while there is a concerns on the volatility front, But I think the point that you highlighted, Rajeswari, in the end, this rather brings a lot of stability to the whole initiative. So it's a great step and a lot of things to look forward to. Thank you both for really very, very enriching conversations. It was very, very insightful. And of course, all the participants, you've been there. I think you're still there, and that's great. That shows the interest that you have, and of course, the value add that both of you have really been making. So excellent session.
Thanks a lot. Thanks a lot, Maulik, for this great
and thank you,
opportunity.
Krushi, for managing all of us and ensuring that we all delivered this.
Thank you so much for giving me an opportunity to listen to Sir. That's always a pleasure and an honor. And thank you so much for at least giving me the opportunity to keep thinking about this issue, which is very relevant for India right now. Thank you, Maulik.
Thank you so much.
Thank you.
Thank you.
See you.
Bye-bye.
Thank you
Bye.
all.
Thank you.